Welcome, and thanks for joining us. Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the File folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. We're now ready to begin. Thank you.
Good morning, everyone, and welcome to our webcast this morning. Today's webcast, Your Path to Tax Savings. The webcast will focus on the latest iteration of the government's semi-annual tax extenders package. You'll learn about select credits and incentive opportunities that came out of the PATH Act. Specifically, we're going to be talking about tangible property incentives, the research and development tax credit, and hiring credits. These tax savings opportunities can all add up to an increase in cash that you can reinvest in your business or use for vacations, which would have you reinvesting in other people's businesses, which is all good. So before we get started, let's take a moment for introductions of the fine folks from Moss Adams' Tax Specialty Group, which will be leading the presentations today. First off, I'm Jeff Shilling. I lead the Tangible Asset Incentive Services practice here at Moss Adams. I provide oversight and technical expertise related to cost segregation, tangible property regulation, allocation of purchase price, and tax depreciation optimization studies.
Hi, I'm Star Fischer. I'm a partner at Moss Adams, and I work with companies of all sizes and across all industries that claim the R&D tax credit. I'm also a member of the IRS Advisory Council and spend a significant amount of my time defending credits through IRS and state examinations.
And I'm MaryCailtin Willcuts. I focus primarily on the Work Opportunity Tax Credit. I currently manage the Moss Adams Max Credits program, which is a full-service platform for the WATI, Federal Empowerment Zone tax credits, and WATI equivalent state hiring credits.
Thanks, Star and MaryCailtin. So with that, let's jump right into the PATH Act. PATH is an acronym for Protecting Americans from Tax Increases, which I got to say is one of the better acronyms they've come up with lately. But that is exactly what it would have happened had this extender package not occurred. As we've all experienced, Congress routinely extends a variety of assorted individual and business tax credits, deductions, and other tax savings laws which have been on the books for years, but which technically are temporary because they've all got specific end dates. This package of tax breaks has repeatedly been temporarily extended for short periods of time, and as we all know, the last several times, or at least the last couple of times, retroactively extended, which leaves businesses and individuals in a constant state of not knowing what the tax laws are going to be, which is always difficult. Because they all have specific end dates and they have to get extended, we've begun referring to this package of tax benefits as extenders. Most of the tax breaks included in the PATH Act expired at the end of 2014. At least this time, Congress has done a better job with the extender package. Instead of just rolling the package of provisions over for a year or two, it actually made some of the provisions permanent and extended the remaining provisions for somewhere between 2 and 5 years, along with making some significant modifications to a number of the provisions. Signed into law concurrently with the PATH Act was the Consolidated Appropriations Act, which kept the government funded, which is important, delayed certain Affordable Care Act provisions, extended and phased out certain energy credits, and created an accounting method change related to transportation costs for oil refiners, which I'm sure was very important to them. While focusing today, our focus today will be on the tangible property incentives, research and development credit, and hiring credits, but in fact the PATH Act included much more. But just to give you a bit of flavor, some of my favorites: minimum low-income housing tax credit rate for non-federally subsidized new buildings was made permanent. The enhanced charitable deduction for contributions of food inventory was also made permanent. The new markets tax credit has been extended now through 2019. 3-year depreciation for racehorses extended through 2016. And finally, fruit or nut-bearing plants are now eligible for bonus depreciation when planted or grafted rather than only when they become income producing. I encourage everybody in the audience to review the PATH Act for other business and or individual benefits that we likely will not be covering today. As indicated, our focus will be on those 3 elements. Which brings us to our first polling question. Which path are we on today? Is it Program for Appropriate Technology in Health, Portable Automatic Target Handoff, Planning Alternative Tomorrows with Hope, or Protecting Americans from Tax Hikes? Which indicates that even accountants can find the acronym page. So lock in your answers now. I'll give you about 20 more seconds to do that. So it looks like some of us are having fun with acronyms as well. The answer, of course, is Protecting Americans from Tax Hikes. And with that, we will move into our first section, the tangible property incentives, of which the PATH Act included numerous ones. We're going to focus on 4 of them. Tangible property tax incentives can generally be described as timing differences, which our tax code regularly uses to incentivize behavior, i.e. create economic stimulus, by reducing or delaying taxes, thereby allowing you to reinvest in your business. As we all know, tax code is full of timing differences. One method of maximizing those timing differences is with a cost segregation study. The cost segregation study, as indicated on the slide, is a tax deferral study that identifies, separates, and classifies real and personal property assets or buildings and equipment components into shorter recovery periods. Some cases, no recovery period or immediate expense, which of course leads to either tax deferral or, some cases, permanent tax savings. As indicated, the PATH Act 2015 includes numerous provisions which enhance timing differences for tangible property investments. So what's changed with the PATH Act of 2015? First of all, expensing under Section 179 has been made permanent at the levels that were established in 2010, which are $500,000 of tangible business property that can be expensed upon purchase, and that is, of course, new or used property, and then it has a $2 million phase out, which just means for every dollar invested above $2 million in the year in tangible property reduces that $500,000 expense level or expense amount on a dollar by dollar basis. So essentially it phases out completely at $2.5 million. But this was very welcome news to small businesses, as it allows immediate expensing of tangible property purchases. It also, along with the cap, the previously in 2010 qualified real property, if you met one of the definitions we're going to talk about in a moment, you were limited to using the 179 expense level to $250,000. That limit has been removed, so expensing can also be available for the definitions of qualified real property. Related to the qualified real property, that's qualified leasehold improvement property, qualified restaurant property, and qualified retail improvement property, or QLIP, CRP, or CRIP, as we like to say in the business. Those 15-year lives for those property types have been made permanent. And as a quick reminder, qualified leasehold improvement property is property placed in service by a lessor or a lessee for the internal area of a building subject to a lease between non-related parties and doesn't impact the core of the building. Elevators and escalators are excluded as well. Qualified restaurant property, improvements made to a building or the building itself where 50% or more of said building is dedicated to on-site consumption of on-site prepared meals. Also, one thing I missed with a qualified leasehold improvement property is that these are improvements that are made 3 years or more after the building was originally placed in service. Qualified retail improvement property is improvements made to the interior of a retail building 3 years or more after it was placed in service. And to qualify as a retail building, you have to be open for distribution of tangible goods to the public. So again, those 15-year lives were made permanent under the PATH Act. The PATH Act also extended and phased down the bonus depreciation. So 50% bonus is now, we now know that that's going to be good through 2017. And then in 2018, it drops to 40%. 2019 drops to 30% and goes away. For long period production property and certain aircraft, those dates all move forward 1 year, so 2016 through 2020. Finally, as far as what's changed via the PATH Act for tangible personal property, or at least the tangible property, the highlights that we're covering, they made a change to the definition of bonus eligibility for qualified property. So previously, only qualified leasehold improvement property or property from one of the other definitions that met the definition of qualified leasehold improvement property as well. Those were the only ones that would qualify for bonus. Now the bonus regs, the portion of the code that covers bonus, includes a new definition, qualified improvement property, which is eligible for bonus, and that is any improvements made to the interior portion of a non-residential building after the building's been placed in service. So no 3-year rule, but it does have to occur after the building's been placed in service. And that property or those improvements will be eligible for bonus. If you don't meet one of the other definitions, qualify, QLIP, CRIP, or QRIP, then the property would be 39-year property, but would be subject to bonus depreciation. So you could have different elements of your building improvements that could be 15-year subject to bonus or 39-year subject to bonus. And if it involves exterior work to the building, you could be 39-year and with no bonus. So who's impacted by these provisions? Essentially, anybody placing capital investments in service is going to be impacted, whether it be through 179, increased expense levels, or whether it be real property, and or knowing that the bonus depreciation has been made permanent. Essentially, anybody that wants to reduce their tax liability and is making capital investments, these provisions will benefit you. And related to the qualified improvement property, this is especially beneficial to building owners making interior improvements, as the other thing the qualified improvement property definition takes away is subject to a lease. So you can be related parties, or you can be the building owner, which is going to be specifically beneficial to businesses like dealerships, medical clinics, hotels, motels, restaurants, that sort of thing that maybe didn't have the availability of bonus prior to the PATH Act. And what are the benefits? So again, timing differences, increased cash flow by reducing current tax liability, essentially time value of money. My favorite of all time, and what really cemented home for me the whole concept of time value of money, of course, was the Popeye cartoon in my youth with not Humpty. I'm drawing a blank on his name at the moment. But anyway, I gladly pay you Tuesday for a hamburger today. And if that doesn't cement it for you, I don't know what will. That brings us to a polling question. So in the presentation, these last 4 slides, QRP, or CRIP, stands for questionable refund property, qualified restaurant property, qualified retail property, or is a low power transmitter. As you can see, I really had a good time with that acronym page. And I'll give you 20 seconds to answer the question, and we'll see what the answers look like. And hit the submit button when you've made your answer. And this was a bit of a trick question in that we talked about qualified restaurant property, and we also talked about qualified retail improvement property. So the QRP, or CRIP, or CURP, probably my pronunciation that confused all of you. Qualified restaurant property doesn't involve the I, and so it's QRP. Qualified retail improvement property does include the I, and so is the CRIP. And with that fun, we will turn it over to, I'm sorry, I've got one more slide. Recap and next steps. So, quick recap, PATH Act includes a number of provisions for increasing deductions related to capital improvements. We hit the highlights, but as indicated in my introduction, there are others that impact fruit and nut-bearing plants, racehorses, racing entertainment establishments, so a variety of other things in the PATH Act. Cost segregation professional understands these rules and has the engineering background necessary to maximize the timing benefits and understands all parts of the PATH Act and other property rules, and so can maximize depreciation for you. Contact your cost segregation professional to evaluate an opportunity where you've made a significant capital investment. And with that, I will turn it over to Star.
Thanks, Jeff. I'll be covering the R&D tax credit portion of the PATH Act. There were 3 major updates that happened as part of the PATH Act that we will cover. First, I wanted to go through, just for those of you that are not as familiar with the credit, background on the R&D credit itself. There's a 4-part test that taxpayers must meet in order to claim the credit. Basically, it's for new product, new process development, or improvement to products or processes. There's 3 types of qualified expenditures: wages, supplies, and contract research. And typically, the credit falls between 5 to 10% of those expenditures, and that is a dollar for dollar return on tax filed on your annual tax return. The PATH Act made a few changes that were very significant, especially for taxpayers who have been unable to utilize the credit. Although the credit is 5 to 10% of qualified expenditures, there is some requirements. One of the requirements is you have to actually be paying income tax. So you have to be in a profitable situation. And you also have a limitation by alternative minimum tax. So the PATH Act addressed both of those issues. The biggest news was that the R&D credit is now permanent. Historically, since it was enacted in 1981, it expires every 1 or 2 years, and then Congress retroactively reinstates it. They actually made it permanent this time, so now taxpayers can count on having it and plan accordingly for that. In addition to it being permanent, the 2 items that were added were the payroll tax credit and the eligible small business credit, both taking effect in 2016. However, the payroll tax credit is elected in 2016, and then actually you receive benefit in 2017 after you file your 2016 return. We'll start with the payroll tax credit. So this is really designed for companies who are in startup phase. The push was that these companies typically are investing heavily in innovation and R&D. However, they're not currently making money, and so they're not taxable and unable to use the credit. So what we had was our taxpayers that were investing the most in R&D were not actually receiving the benefit. And so this is specifically for those companies. In order to qualify, you have to be under $5 million in gross receipts in 2016, and you could not have any revenue prior to 2012. So it really is designed for those startup companies. You also have to have significant payroll expense because it is a payroll tax credit, obviously engaging in R&D activities, and there are aggregation rules, and what that means is that ownership comes into play. If you have companies with the same owner, for example, that $5 million threshold is going to be determined on a combined basis. The benefits of the payroll tax credit, you can get up to $250,000 in benefit. To do that, you would need approximately $4 million in total payroll just to have enough tax to really be able to benefit the full $250,000. It can be elected up to 5 years, but the key there is it has to be your first 5 years of revenue. So if your first time you had revenue was in 2016, then you could elect it for the full 5 years. There's still a lot to be more guidance needed in this area. There's a lot of things that are not very well defined because you elect it on an income tax return, but then you actually claim the credit on a payroll tax return. There's just some disconnect on how it actually all works. So the IRS Congress mandated the IRS to come up with to issue regulations this year around specific areas. So there'll definitely be more guidance on this throughout the year. The next one is the eligible small business credit, and this has been in law before in 2010. So it's really just reinstating that and making it permanent going forward instead of a 1-year reprieve from AMT. And this applies to companies with less than $50 million in average gross revenue, and average is over the prior 3 years. So much higher threshold here. And this is really for companies that were limited or paying alternative minimum tax. The limitation is you can only use R&D credits to offset regular tax liability. You can't use it to offset alternative minimum tax liability. So what this does is allows taxpayers who meet eligibility requirements to actually offset some of their alternative minimum tax liability. Again, you must have supportable R&D credits. So what are the benefits? As mentioned, you get to take away that AMT limitation, so you can use it to possibly offset up to all of your regular tax liability. There are some additional limitations that need to be considered, but you could use a significant portion to offset your tax liability. This results in greater usability in the current year, so you're not having to carry forward those credits to a subsequent year. Now it brings us to a polling question. A company must have under $5 million in gross receipts to qualify for the eligible small business AMT exemption. Give you time to submit your answers. Make sure you click submit when you're done. Okay, let's see the results. And the answer to that one is actually false. The $5 million threshold is for the payroll tax credit. The eligible small business credit is a $50 million threshold. So big difference there. But it's been a common question that we are getting. So the next steps and recap, if you haven't been able to utilize the credit in the past, either because you are not paying tax or you're limited by alternative minimum tax, now is a really good time to revisit, is there opportunity to benefit from the credit? Startups and companies without taxable income may now benefit, and that's a big change, never been in R&D law before. So contact your CPA or R&D professional to evaluate the opportunity. Now I'll turn it over to MaryCailtin.
Thank you, Star. So in addition to the tangible property incentives and the R&D credit, there were also 2 federal hiring credits extended. One of those is the Work Opportunity Tax Credit, which we also refer to as WOTC. The WOTC is a federal tax credit that may be used to offset federal income tax liability. The credit was originally created as an incentive for businesses to hire individuals who have been deemed statistically at a disadvantage for employment, and to help get them back into the workforce. So just a few examples of those types of individuals would be food stamp recipients, ex-felons, and veterans. In general, the WATI is a 1-year credit per employee, and by employee, we are referring to first-time hires only. This is also a prospective program with a 28-day filing requirement per qualified employee. And while this is a federal credit, it's administered at the state level by state coordinators. Those state coordinators verify qualified employee information and then issue certifications that allow businesses to begin calculating the eligible credit. A big change that was included in the PATH Act is an extension for WOTC for 5 years. That's really exciting. That's the first time we've had a solid 5-year extension in a long time. The extension is retroactive to January 1, 2015 through December 31, 2019. There was also a new long-term unemployed target group added. We are referring to the long-term unemployed target group as LTU. Currently, the LTU is available for new hires beginning January 1, 2016. And the current requirements include that the individual must be unemployed for at least 27 consecutive weeks, which is also about 6 months. And at some point during those 27 weeks, they received unemployment benefits from either a federal or a state agency. So something to consider, new hires coming out of college or technical school that historically would most likely not have qualified. Under this new LTU target group, there's a chance that they may qualify now. So with the new LTU target group, there is a broader range of individuals that may qualify, which also broadens the industries that may be eligible for the credit than historically. Companies that did not screen eligible employees for the WATI during 2015 may be given a transition relief to screen for those individuals. And going forward, companies hiring qualified employees are eligible to screen for WOTC until December 31, 2019. But also keeping in mind that there is a 28-day filing requirement per employee. So in our experience, some of the industries that have tended to benefit the most from the WOTC are industries like assisted living facilities, transportation, retail and grocery, really any business that's hiring veterans or implementing a veteran initiative program in 2016, hospitality, and of course, staffing companies. So the WOTC is a general business credit. It's available to be claimed in the year in which the state issues certifications. The maximum credit amount that may be available can range from $2,400 to $9,600 per qualified and certified employee, depending on what target group the state certifies the employee under. So if you really think about it, this can add up and be a pretty significant opportunity. Additionally, there is no limit to the number of certified employees a business may claim the credit for. The other hiring credit that was extended as part of the PATH Act is the Empowerment Zone Tax Credit. As mentioned, this is also a federal tax credit. It's an incentive for businesses in federally declared distressed communities to create economic growth and reduce unemployment. So in order for a business to qualify, they must have a location in an empowerment zone, and they must also hire employees that live and work in the zone. The credit can also be taken each year the employee is retained and continues to live in the zone. So for empowerment zones, the biggest change was an extension for 2 years, retroactive to January 1, 2015 through December 31, 2016. Something to keep an eye out for, there may be some changes made to the number of current empowerment zones as well as the size of the current empowerment zones. As mentioned before, essentially any business residing in an empowerment zone may qualify as long as they are hiring employees who also live in the zone. You'll see on your screen we have a map that identifies states that currently have empowerment zones. Those states are those in dark blue. There can be more than one zone per state, as well as I previously mentioned, the size of the zone can vary, and it can vary pretty significantly. But this just kind of gives you an idea of where zones are located in the United States. But for more details, we do have information on our website if you'd like to learn more. So the Empowerment Zone Tax Credit is also a general business credit. It is available to be claimed for each qualifying employee in the year they generate credit. There are no certification or filing requirements. The maximum amount may be up to $3,000 per qualified employee each year they continue to live and work in the zone. Additionally, there is no limit on the number of qualified employees a business may claim the credit for. All right, so we've reached our last polling question. So this question reads, what is the range for the maximum available WOTC a business may claim for a certified new hire? So you have 4 answers to choose from. First one is $3,000 to $8,600. The second is $2,400 to $9,600. Third is $2,000 to $9,800. And the last choice is $1,400 to $9,600. So we will leave the polls open for about 30 seconds. Once you select your answer, make sure to hit the submit button in order for your answer to be counted. So we've got 30 seconds. All right, so we've got about 10 seconds left, so if you haven't submitted your answer, please do so now. All right, we're going to close the polls. All right, the answer is 2,400 to 9,600, so the majority of you got that right. I appreciate you listening. Okay, so for next steps, please don't hesitate to contact us or your state and local tax professional to see if your business, client, or prospect may benefit from the WATI or Empowerment Zone tax credit. Additionally, there are many states that have WATI equivalent hiring credits that businesses may also be eligible for in addition to these federal hiring credits. So there may be an opportunity to double dip. All right, so we've got about 20 minutes or so, 10, 15, 20 minutes or so left for Q&A. To ask a question, click on the Q&A icon in the bottom left-hand portion of the icon bar. When you click on this icon, it will activate a text box where you can type and submit your question. So we will do our best to answer all your questions, but if we do run out of time, we will follow up with you via email. So it looks like Jeff is going to take our first question.
Yes, thank you, MaryCailtin. So we do have a number of questions. The question board will, as MaryCailtin indicated, will remain open. So if in our explanations we don't fully answer your question, or if you've got a follow-up, we've got a fair chunk of time left. So please go ahead and just resubmit or add to it. But the first question, and we do have a couple of handfuls here, so we'll try to get through all of them. First question was, do you typically see your clients electing 179 or bonus depreciation? Can you go through the internal process you see clients go through to make this determination? Most of our taxpayers are intensely interested in reducing tax as much as possible. So they, if they've made less than $2 million worth of investments, exercising 179 expense levels to their maximum, is essentially the same as 100% bonus depreciation, and we'll see them taking advantage of that. Over $2.5 million, of course, 179 is fully phased out, and so they're going to be taking advantage of bonus depreciation. It's been a while since I've worked through a client or worked with a client relative to should I be taking 179 against real property improvements. Of course, that would be the next answer, because it would otherwise be 15-year property. So if you can fully expense QRP, QRIP, or QLIP, then of course that's what you're going to do, because anything remaining in that asset group or classification is going to be depreciated over 15 years. So you're going to maximize your ability to expense those categories first, and then utilize bonus depreciation after. The other thing, I'm not sure if I mentioned it, but these expense levels have now been made permanent. So even when bonus goes away after 2019, you will still have these expense levels, short of any other changes. The next question, I hope that answered the first one. The next question is, what is the leasehold improvement life with buildings less than 3 years in service? Is it the same as the building life? And I may have missed that on the definition of qualified improvement property. But if it's improvements made to the interior portion of a building after the building was originally placed in service, so that can be as short as a day, and we do expect additional guidance on that, to figure out what exactly they meant. Does depreciation have to have started? Do you have to have taken some depreciation expense on the original building? Or is it essentially saying you build the shell first, and then when you start making improvements to the inside, that's after the rest of the building was placed in service, which could be the case, of course, for a building held for lease. So we're looking for additional guidance on that, but essentially, if it's improvements made to the interior portion of a building, they are subject to bonus, but would have the 39-year life. So yes, it would be the same as the building life. And then also under the definition of QIP, that only is available for non-residential real property. So it would be 39 years. Hope that answered that. And with that, it looks like our next question is related to the WATI credit.
Okay. So one of the questions is, what are some empowerment zone cities in Washington and Oregon? And unfortunately, Oregon and Washington do not currently have any federal empowerment zones. So, sorry. And another question is, can you take the WOTC and the empowerment zone simultaneously on a qualified employee? So yes, you can take both. WOTC comes first, so you calculate the WOTC credit on the gross wages first, and then whatever gross wages are remaining, that can be used for calculating the empowerment zone. So depending on the total number of gross wages the employee earned in that tax year, depends on the resulting amount of empowerment zone credit you'll be able to claim. Another question, how do I know if my business is in an empowerment zone? So there are a couple of ways to determine that. If you have a lot of locations, you can always feel free to reach out to us and we will do a scrub and let you know what locations fall in a zone. But if you only have one or two locations, the Housing and Urban Development website has a zone locator tool, but Google actually has a really handy, intuitive, interactive map for empowerment zone searches where you can enter a single address at a time. And then there's another question, can an S-Corp take the WOTC? Does it pass on to the shareholders? Yes, an S-Corp can take advantage of the WOTC, and it does flow through to the shareholders.
All right, looks like the next one is R&D. The question is, can any of the new R&D credits be carried back to 2015 returns? Great question. So if it's eligible small business credit in 2016, there's actually a 5-year carryback provision, so you can carry it back 5 years, and it also is not limited by AMT. If you can't use it 5 years ago, then it carries forward for up to the 20 years past 2016. So there are carryback, carry forward provisions. The next question was also R&D. Once an R&D tax credit becomes a general business credit on Form 3800, can an individual use it to offset tax liability, no matter which entity made the profit? This does get complicated, but it's a great question. If you're a pass-through entity and you do not have income from that entity or taxable income from the entity, you cannot use the credit to offset income from other sources or tax from other sources. However, if there is income from the entity and you're limited in that year because of AMT, then the credit will carry forward and it can be used to offset other tax liabilities. So there's a lot of complexity around that area. For the payroll tax credit, it'll be on a payroll tax form, and the carry forward provisions say that it'll carry forward to each successive quarter if it's not fully utilized in one quarter. So different carry forward provisions there. And then MaryCailtin, did you have the next one?
Let me see here. I'm flipping through these to see if I can find the next question. So it looks like there's a question in here asking how do you screen new hires? And is it during the employment application process or after the employee is hired? So the purpose of the WATI program is for employers to hire individuals that qualify for the program. So essentially, the government asks you to screen the employees on or before their first day of work. So it wouldn't be after they are hired. It would be either during an application process or during an orientation process. depending on how your business does their onboarding. And to screen new hires, there are a lot of firms out there that have electronic screening tools. Moss Adams does have one. It's our Max Credits tool, where new hires go through a short survey to answer the applicable questions, and then the system can determine qualification and allows them to then electronically sign forms in the real time. For smaller businesses, there is a paper process that you can follow with instructions on the Department of Labor site.
Okay, there's a couple more R&D ones here. The one is, can you claim the R&D credit in a year which the business has a tax loss? I think we might have covered that in the last question as well, but just to reiterate, you can claim the credit, you just don't have any tax to actually utilize the credit or offset that tax. So it'll carry forward. Traditional credit carries back 1 year, forward 20 years. The eligible small business credit can carry back 5 years and then forward 20. The next one was, what form do we use to calculate the payroll tax credit? And that is, the credit is actually elected when you file your 2016 tax return. So it could be an S-Corp return, a partnership return, corporation return, so 1120, 1120S, 1065. But then it's elected on that form, but then it will actually be filed on the Form 941 quarterly, the quarter after you file your tax return. So second quarter 2017 is the earliest that you can actually benefit from the credit. There's one more R&D one here, this has become a very common question, so I'm glad someone raised it. If a business uses a PEO, which is a professional employer organization, or leases its employees, can it still use those wages to claim the credit? And that is a question that is not completely answered yet. We are going to be looking to the IRS for some guidance on that. It is assumed that yes, because as the taxpayer and the client of the PEO, you are responsible for paying those taxes, then it should be used to offset the payroll taxes accordingly. But we do not have definitive guidance on that area quite yet. We are looking into it. I believe that was the last R&D question.
Okay, we've got a number of questions related to tangible property incentives. First of which, can you please help explain the difference between Section 179 and bonus depreciation? The biggest difference is, other than the phase-out caps, is that we've already discussed, was that Section 179 expensing does not require original use of the property to start with the taxpayer that's currently taking the expense. So put that another way, you can buy used personal property or tangible property, given that any used real property wouldn't fit those definitions. But if you're buying used personal property, it can qualify for the 179 expense. It will not qualify for bonus depreciation, as bonus depreciation by definition requires original use with the taxpayer. Hopefully that covers that, or follow up and I'll be looking for another additional question. I've got a question from a Moss Adams employee, which is always interesting. Can you review when bonus depreciation applies to QRP and QRIP? Glad you asked that, because I failed to mention that internally we distributed what we refer to as our annual cheat sheet for bonus 179 and qualified real property definitions or updates. We are currently working on that to issue externally as well, and so should be out soon. I would expect that that would answer your questions. Actually, I know it does, since I had a big hand in writing it. It talks about where QRP qualifies for bonus and where QRIP qualifies for bonus. For those that don't have that cheat sheet yet, as long as you meet the new definition for 2016 and forward of qualified improvement property, any improvement to the interior portion of a building, essentially qualifies for bonus. So if you meet that definition under QRIP or QRP, then you would also qualify for bonus. The qualified restaurant property, QRP, can include the entire building. So clearly the shell of the building, any exterior or anything on the roof, windows, doors that impact the exterior walls, those things will not qualify for bonus. Qualified retail improvement property, by definition, basically everything there is placed in service after 2015 will qualify for bonus. And as long as it also meets the definition of qualified leasehold improvement property before 2016, which would make it only for buildings that were placed in service 3 years prior to the current improvement, those also qualify. So essentially, QRIP can qualify before 2016 if it also meets the QLIP definition. After 2015, it's always going to qualify for bonus. Hopefully that answers that. And moving on to the next one, if you claim bonus depreciation on qualified real property improvements, how is that recaptured when the property is sold? Bonus depreciation is treated essentially the same as accelerated depreciation. So you're going to have recapture at ordinary rates up to the value received for the property that was sold. Hopefully that answers that. And let me scroll forward. Actually, why don't I turn it back over? We can answer some WOTC questions so that I don't hog the remainder of the time. So, MaryCailtin?
So there's a few empowerment zone questions. One of them I see in here, are there empowerment zones in Alaska? Unfortunately, the answer is no, not currently. Another question, are there empowerment zones in Northern California? Not necessarily in Northern California. The California Enterprise Zones currently reside in the Fresno, LA, and Santa Ana areas. Another question, how does a city become an empowerment zone? That's a really good question, and I don't have a really good specific answer for you. I do know that there is a filing requirement by jurisdictions to request federal funding in order to create empowerment zones, but I can follow up with you with some more specific information. Let's see here. So if there are any other questions related to states that have zones or where zones may be located, on our Moss Adams website, we do have more information relating to the states that have zones and then within those states where those zones are located. So please feel free to check out that site as well if you have some additional questions related to that.
Do we see, yeah, there's one more R&D question. If Star wants to take it.
Okay, here. So the R&D tax credit carryback to offset alternative minimum tax, 2015, 14, 13, 12, 11. So I think this is referring to the carryback provisions. So for credits generated in 2016, you can carry back those credits for 5 years. So back to 2011. If you cannot use it in 2011, maybe you didn't have enough tax or other limitations, then it'd carry forward to 12 and then successively until it is absorbed. If it can't be used in any of the prior 5 years, or maybe if you're a C Corp, you were in business 5 years ago, then it would just carry forward for up to 20 years. But yes, for that carry forward for the 16 credits, there is no AMT limitation in any year that you carry it to. Hope that answers the question.
Got a couple more tangible property related questions and a little more time. So can you provide more detail on QIP? Would improvement to framing and drywall, ceiling, and plumbing systems qualify? Yes, it would, as long as we're talking about interior improvements and made to the property after the shell was placed in service, then that would qualify. Elevators, escalators, and certain structural work to the shell essentially are the only things that don't qualify under QIP. And keep in mind that qualified improvement property is a definition that is only related to bonus eligibility. It's not a specific class of property. It just defines what is bonus eligible. You must meet one of the other definitions in order to get the 15-year life for the non-50%. We've got 1 minute left. I'm going to try to fit in one more, and it says, does the $500,000 bonus depreciation and phase-out apply to each taxable entity or on an individual taxpayer? I'm going to have to get back to you on that one, because when we get into consolidated groups, that gets beyond my confidence of answering immediately. So I'll get back to you on that one. And with that, we're out of time.
Yeah, so thank you everyone for joining us. We will follow up via email with a copy of the slides, as well as contact information in case you have any additional questions. We will also follow up with any additional questions that we weren't able to answer, or promise that we would follow up if we didn't have a good answer. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet in order to receive the credit. If you participated as an individual and met all certification requirements, your certificate is available to download now with the CPE icon at the bottom of your screen. So if you just click the CPE icon and then select the printer, you can download a PDF copy of your certificate. We will also keep the webcast console open for a few minutes just to give you some time to download your CPE certificate. But a copy of your certificate will also be emailed to you within 2 weeks if you have any issues doing it now. So thanks again, everyone, for joining us. And please take a moment to complete the short 1-minute survey that's currently on your screen.
Thank you.
Thank you.